Failure should inspire you to get smarter. If you learn never to work for money, you'll be a rich man.
Robert Kiyosaki is a successful businessman best known for his book Rich Dad, Poor Dad. He founded Rich Global LLC, a financial education company that provides finance and business education to students through books and videos. He is also a successful businessman and investor who owns multiple businesses and made many types of investments. Today, Robert is worth around $100 million. Robert, though, wasn't always as wealthy and successful as he is now. In fact, he had multiple failures before reaching his current level of accomplishment, which only came later in his life. His career was actually spent more in studying money, investments, and business management. In this video, we will talk about Robert's key lessons on how you can avoid the rat race and achieve financial success. So stay tuned because we will also discuss how you can apply them to your own goals. So make sure to watch this video to the end. This is Financial Intellect, where we promote that to be finance savvy, we are your buddy. Now let's get right into the video. Number 1. Gain experience in financial literacy. To be financially wise, Robert recommends learning how to do accounting, investing, legislation, and how markets work. It's critical to understand how money works in order to take advantage of it. There are numerous aspects to financial knowledge, and there is a lot to learn. However, these are unfortunately not stressed in school. Management and communication skills are equally vital in schools. However, it prepares students to be effective employees rather than business owners and investors. When Robert bought his first investment property, an $18,000 apartment in Hawaii, it didn't make him wealthy. However, the expertise he gained was invaluable, allowing him to do larger deals in the future. In business and investing, taking calculated risks is crucial. Number 2. Stay away from self-doubt and dread. Anyone who has built their own success will tell you that failure is an unavoidable part of the process. Robert himself has failed in a number of business and financial enterprises, yet he doesn't allow his failures to hold him back. If you have an amazing concept for a new business, anxiety and self-doubt may hold you back from moving forward with that idea. But remember, the people who became wealthy were not necessarily the brightest, but the most courageous. They aren't frightened to take risks because they understand that failure is always a possibility. They understand that the return is worth the risk. People who are wealthy take risks because they see opportunities in life that could turn them into billionaires. Number 3. Master the art of selling. A woman with a master's degree in English literature once asked Robert about how to become a best-selling author. Understanding that her writing talents were not the most crucial component, Robert urged her to enroll in a sales training course. His response initially surprised the woman, who even asked if he was serious. Picking up a book from the coffee table, Robert responded that there's a reason why successful books put best-selling author rather than best writing author. Robert emphasized that if you want to be wealthy, you must be able to sell. He himself turned away a well-paying career in the oil industry to learn how to sell at Xerox. Go beyond your comfort zone. Practice networking and selling. You'll never be able to run your own business if you don't. Before we move on to the next lesson, if you love content such as this, give this video a like, subscribe to the channel, and turn on the notification bell so that you will know when we've posted new videos. We'd love to give you more content such as this. Now moving on to the next lesson. Number 4. Focus on how you can afford it. One of the qualities that contributed to Robert's success was that he never declared he couldn't afford something. Rather, he'd think to himself, how can I afford it? What can I do to reach that objective? Simply stating that you can't afford it puts a stop to any further creative thought and kills any possibility. When you ask yourself, how can I afford it? You open up opportunities for possibilities, excitement, and a goal. The poor middle class is frugal, which implies that they won't gamble. They will not take risks because they lack a firm financial foundation. Simply feeling that something is beyond reach might lead to year after year of working for someone else doing the same thing. The poor middle class believe that they can get a raise or promotion inside their workplace if they work hard enough, and they are satisfied with it. However, that is not the mindset of a wealthy and successful person. Number 5. Understand the tax system. You have to understand that those who work for someone else pay the highest percentage of their income in taxes. When you receive a paycheck, your taxes are deducted before you receive it. So technically, you're spending after-tax money when you spend it. However, entrepreneurs are the opposite. They make money, subtract expenditures, and pay taxes on their net income, which they spend before tax dollars. For example, when a business owner makes $100,000 per year, they do not pay tax on the entire sum. They understand that anything the corporation can legally purchase can be subtracted from its income. With the assistance of a legal team, it would be fair to decrease that taxable income to $50,000 by deducting the company expenses, resulting in a $50,000 taxable income rather than paying taxes on the entire $100,000 in gross revenue. An employee who makes $100,000 per year pays taxes on the entire amount, potentially leaving them with only $80,000 in after-tax income. Then the money left over is the one they will use to cover their expenses. Similarly, money withdrawn from a 401k is taxed at regular income rates, which are often higher than the long-term capital gains rate of 0 to 20% that would be paid if the money were invested in a traditional brokerage account. Because taxes were avoided by investing in a 401k, when they take money during retirement, they will be obliged to pay taxes on all of the money they withdraw at the higher income tax rate, thereby nullifying any tax savings. 401ks also don't allow you to leverage your money. It's considerably more difficult to invest with leverage in a retirement account, which restricts the types of investments that may be made if you invested in rental property instead. Depreciation, expenditures, and mortgage interest are all allowed by the government. The gains are usually taxed when the property is subsequently sold. The low tax rate of 0 to 20% is frequently lower than the tax rate most people pay on their 401k. The government has a lot of limitations about how much you can put into it, when you can take it out, and what kinds of investments you may make within it. This is why Robert advises against investing money into a 401k because it only provides brief tax benefits and has other negative repercussions, including those listed above. Those looking to develop wealth and minimize their taxes over time should instead invest in businesses, real estate, commodities, and other such assets. Number 6. Acquire assets rather than liabilities. This is Robert's most important lesson. He sparked a lot of debate when he said that your house isn't an asset, but rather a responsibility. He makes the point that owning a house costs money each month in the form of taxes, insurance, maintenance, and a mortgage. Thus, whether you agree or not, it is recommended that you should instead buy assets that put money in your pocket on a regular basis rather than on something that costs money and loses value, such as an expensive phone or car. A rental property that creates monthly cash flow is a perfect example of an asset. The middle class becomes trapped in the never-ending rat race because they spend their paychecks on obligations, frequently borrowing money from the bank to do so. It's fine to purchase liabilities, but only after you've secured assets that will cover them. In other words, if you want to buy a phone, consider making an investment that will help you pay for it. Don't get caught up in the rat race, earning lousy earnings until you're in your 60s to retire, or worse, you couldn't even retire because of a complete lack of financial literacy. If you don't have the money to buy something you desire, instead of simply feeling like it's impossible, figure out how you can. Use the tax code to your advantage to avoid paying more tax than necessary. Instead of being scared away by the threat of failure, learn as much as you can via experience and take smart risks with great potential. And those are the 6 life-changing lessons from Robert Kiyosaki that can help you escape the rat race and be financially successful. What are your thoughts on this? Do you agree with Robert's lessons? Let us know in the comment section below. We'd love to hear your thoughts on this. And with that, thank you very much for watching. If you like what you've watched, stay tuned for more videos. Bye, financial buddies!